Price to earnings, or PE ratio, is mentioned a lot when it comes to understanding the value and price of a company. But what does it actually mean? In this video, we want to define the PE ratio, understand what it means and how it's calculated. We'll then build on this understanding by looking at the difference between growth and value companies on the stock market and how we can put a value on these companies by using just this ratio. The PE ratio is used for valuing a company and measures the business' current share price relative to its per share earnings, also known as the earnings per share or EPS. The ratio is used by investors to determine the value of a company relative to that of other companies in similar markets or industries. Basically, the PE ratio tells you how much investors are willing to pay for the business compared to its current earnings. High PE ratios means that investors predict higher growth in the company's future. They're willing to pay more for the business now because they believe that there'll be significantly higher returns in the future. The average market PE ratio today is 20 to 25 times. It's also important to remember that companies with negative earnings in their financial statements will not have PE ratios. I'll explain this later. The price to earnings ratio is just that, a ratio. Therefore, it's quite an easy calculation to make. You basically divide the share price by the earnings per share figure. If you do not have these numbers, you can work them out by calculating the share price as the total market capitalization divided by the total number of shares, and the earnings per share by dividing the total earnings by the number of shares outstanding. This figure is the price to earnings ratio and tells you a lot about the business's current valuation relative to other companies and about how investors perceive its future growth potential. When using the formula in the last slide, we divided the share price by the earnings per share. However, when deciding on the figure for the earnings per share, there are two different options. Firstly, you can use a trailing 12-month earnings figure, which takes the earnings figure over the last 12 months. Secondly, we can use the company's best educated guess of what it expects to earn in the future, found in the company's earnings release. Whichever you use, both are accurate enough in their own way. The forward or leading PE ratio uses future earnings guidance and therefore is sometimes known as the estimated price to earnings. It is useful for comparing current earnings to future earnings and helps to provide a more clear picture of what earnings will look like. However, companies could underestimate their earnings to beat the estimated PE when the next quarter's earnings are released. This helps the management team's compensation and outperformance looks great. On the other hand, some companies could overestimate future earnings and revise this further down going forward. The trailing PE ratio relies on the past performance by dividing the current share price by the total EPS figure over the prior 12 months. It's the most popular form because it's the most objective, assuming the reporting company is accurate. However, major company events can take place which significantly changes the share price, and the PE will then be less reflective of these changes. Also, companies release their earnings quarterly, whilst the share price changes every single day. Investors can actually use both trailing and forward ratios together, because they each tell you different things. If the forward PE ratio is lower than the trailing PE ratio, it means that analysts are expecting earnings to increase, and if the forward PE is higher than the current PE ratio, analysts expect a decrease in earnings in the future. Other than comparing the PE ratio between trailing and estimated or forward, we can use the ratio of a company to better value it in relative terms. We can compare the ratio to the following. Competitors, to find the best value business in a sector, or to determine one that is overvalued to one that is undervalued. The industry, if the business is cheaper or more expensive than others in the same industry. A market index like the Dow Jones Industrial Average, and the company's own historic PE ratios to see if the company is more expensive than what it was in the past. Each of these shows a different thing, but generally, the lower the PE ratio, the cheaper it is to buy a share in terms of the current earnings and production of the business. If you're an investor, you want the balance between finding a company that is relatively cheap for what you are getting with a good quality business that will continue to grow in the future. Growth stocks like technology and cybersecurity will generally have higher PE ratios. If we think about companies like Alphabet, Netflix, and Amazon, Their PE ratios are significantly higher than that of General Electric, Ford, and other value stocks. PE ratios are dependent on the industry the business is in, future growth prospects, and general economic conditions. Remember, if you think there's going to be a recession, earnings might dip, and if you think there's going to be an economic boom, earnings could outperform. It all depends on your perception and your own estimates. Remember that this is a relative measure, and the business generally has a reason for being valued at a specific level. For example, if it is cheap, should it be? Are there issues with the business? And if the business is expensive, is there a big opportunity for future growth?